Are you thinking about buying a house? Are you thinking about refinancing a house? Are you thinking about all those debts that I just told you about? Well, here's the simple answers to what's going on right here. Maybe not so simple. But let's just take, I go to the cmegroup.com and they put out the futures forecasts for what the probabilities are for the Fed funds rate. Now, when I talk about the Fed funds rate, why is that important? Because it does not affect mortgages, or does it? They don't set the mortgage rate. They don't set a lot of rates, but here's what they do. And here's how we use that data, how you can use that data. And a lot of people say, well, Ron, I think mortgage rates are going down. Okay, why? And you get that blank stare because they don't know why. They want to come up with something, but the answer to their question when you say why is they got crickets. They have no answer to that. So let me give you the answer. Historic. Let's go to history. So and we're going to use history, and we're going to use economics, and we're going to tell you what we think. So right now, there's about a 60% chance, almost a 60% chance, maybe a little more, that the Federal Reserve will set their benchmark, the discount rate, between 3.75 to 4.0 next year, by the end of next year. 375 to 4. So, and generally what we use the middle numbers, but I'm not going to do that now because it's hard to do the math. That would be 3.875. But here's the issue. The 10-year Treasury is generally, and I looked this up this morning, it'll vary, but it's usually right around a little bit below what the Fed funds rate is. Now, the Fed funds rate right now is, I think it is a little bit above. It's about 3/4 of a point above the 10-year Treasury. We can look up the 10-year Treasury at any given time. All we have to do is go to Google or anywhere else and say, what is the 10-year Treasury yield right this minute? And I can tell you that it's yielding 4.398. That's where the 10-year Treasury is yielding as of right now. And right now, the Fed funds rate, that's about a half below the Fed funds rate. So let's project out. If they're saying that they're looking at, say, 3.75 as the Fed funds rate going into the end of next year, and historically we see the 10-year Treasury about a half a point below that. So now we're at 3.25. And then we look, what's the spread between the 30-year fixed rate mortgage and a 10-year Treasury? Now I see where you're going. So that's the historic, that's about 1.79. So if you were to add 1.79 to 3.25, you would get what the historic number is. But wait a second, we're not dealing in history. We're forecasting. And for about the last year, we've been running at about 2.5 at the spread above the 10-year Treasury to get to the 30-year mortgage rate. So we add 2.5 to that 3.25. That's about a 5.75 as of the end of next year. Now, what do we do with that information? We can come up with all kinds of data and we can come up with all kinds of statistics. But now what do we do with it? Well, we use that to forecast that 5.75 and say, okay, where's your home loan now? But more important, where is your blended household interest rate? And yes, I do have a blended household interest rate calculator. So if I look at the blended household interest rate of what your credit cards are, what your auto loan is, student loans, unsecured debt, secured debt, blend it all together, put it in a blender and weight it. Of course, you got to weight it because I hear so many people say, Ron, I've got a 3.25 mortgage rate. And I say, who cares? You're in debt. We just heard only 14% of the people are comfortable that they're going to be able to make their payments on time. They're going to be able to pay all their debts on time. Yet they do nothing. We've talked about this before. rsrlinks.com/2step. rsrlinks.com/2step. And what we do is we look at these things and I say, okay, now I've got an idea of where interest rates forecasting for next year. So I just told you that based on the Fed funds forecast, the spread to the 10-year, and that spread then to the mortgage-backed securities, that we're looking at about a 5.25% interest rate. What do we do with it? Let's see if we can save money. Now, interest rates don't buy you a thing. If you walk into your favorite store and you go I'm just going to use Amazon, right? Because is anybody not using Amazon for, Josh, I ought to put that up on a poll or something if we ever have a way of doing polls, right? Does anybody not buy on Amazon? I'd love to know if anybody that does not buy on Amazon. We need to put that on our question of the day. Do you shop on Amazon? Yes or no? Pretty simple. Do you shop on Amazon? So here's the issue. Can you go on Amazon and say, I've got a 3.5% mortgage? No. Can you go on Amazon and say, I got a 10% mortgage? No. You can go on Amazon and say, I've got a credit card with capacity on it. That works. Put that in the chat for me. Do you shop on Amazon? If you're listening to us on radio, and yes, we do broadcast and we record live 9 to 10 every morning. And if you're listening to us on radio on ABC News and Talk, 6 o'clock to 7 o'clock in the evenings, well, just yell it out loud because we will hear you. So do you shop on Amazon? I'm going to say yes. Heck, when the Amazon truck doesn't come here, there's a surprise. They're here probably 3 times a week. But I digress. You can use your credit card on Amazon. You can use your cash on Amazon. If you go to the 2-step and we get your debts under control and not worry about that stupid 3% mortgage that you have because it's killing you. We did a whole broadcast segment on it. rsrlinks.com/3pct. rsrlinks.com/3pct. And we show you why a 3% mortgage is killing you. Killing you. Financial suicide. Because you're not looking at your whole household picture. We are certified liability advisors. We help you build wealth through strategic debt management. When you go and you do get your blended household interest rate, and we see what the total debt service is, that means all your minimum payments put together, and how long it's going to take you to pay that off, we restructure it in the first step of the 2-step. You're going to save, generally we see around $400 or $500 a month. Now you can buy your wife or husband or kids, family, relatives, friends, favorite radio host gifts with $400 or $500 a month. You can buy them absolutely nothing with 4%. I digress again. So we're going to do that, and we're going to reapply that to the principal balance. So now you're going to pay off your loan much, much quicker. You're going to also increase your interest rate, or your credit scores. Interest scores, credit scores up, liabilities down, debt to income ratio favorable. We get that all done, and then next year, if interest rates are back at 5.25%, like I just worked out the math with you, I don't know if it's going to happen, but I just gave you the math for it. Well, if it's at 5.25%, we restructure. Step 2 of the 2-step. We restructure your loan, and you end up in much better situation. Now, we've already been making additional principal payments from the cash flow that we saved when we got rid of all your debts. We're going to increase that by half of whatever we save you by restructuring that loan again next year. And we're going to keep watching how the amount you owe on your mortgage keeps going down. Now, step 7 within the Borrow Smart process is discipline. You have to have the discipline to follow the strategy. If you don't have the discipline to follow the strategy, we blow everything up. That's the bottom line.